Hi, this is Jon Moog from the Pengana Global Small Companies Fund. I am the CIO and Portfolio Manager of Lizard International Investors, and I'm delighted to be chatting with you today about our fund and what we think is a great opportunity set in the global small cap space. Today I'm going to be chatting about a little bit about our firm and giving you a quick overview of who we are and what it is we do and why we're so excited about global small cap space. Then I'll be talking more specifically about the opportunity set as we perceive it in the global small space. Then I'll chat a little bit about our philosophy, how we attack the space from a research perspective and a sourcing perspective. We'll get into a little bit about our recent performance and what we're seeing in the current environment, which is, of course, very pertinent given the unusual situation we're all living through now. And lastly, we'll get into some case studies, and then I will turn it over to questions with my partner, David Lee, who will take any questions you might have. So Lizard has combined, the senior investment team at Lizard has been together since 2009. There's a lot of experience on the team, and we have been investing in this space, the global small cap space, for the last 12 years. And I think we've really built a specialized view of the market, in-depth knowledge of our target investment universe, and really honed our research and sourcing capacity specifically for this space. We are based in Chicago, and we think that provides us with a nice opportunity set from a travel perspective of really getting anywhere in the world fairly easily. And for us, in-person research is a big part of the job, as well as over the phone. So I think all those things line up well. Here's the team, and I think I'd highlight myself and David Lee. Again, we started together here in 2008 for the launch of the firm. We've been, we launched our first product January 1st, 2009, and we have been the head of the research and investment process really since the inception of the firm. We've hired some analysts over time, Kevin, Mickey, and Tam, who have really helped us build out our diligence capabilities. And really allow us to kind of put more horsepower into our sourcing and research engines. And of course, our founder is Lee Azell, who is one of the pioneers in the global small cap space. So what gets us so excited about the global small companies space, the niche that we invest in, is we think it's just a very unique space with a lot of alpha generating capability. And why is that the situation? It's a massive universe we invest in. So there are over 50,000 global small companies listed around the world. Of course, we don't view that as our investable universe. However, the universe is very broad and very deep and full of opportunities. The second point here is a lot of these names are underfollowed by sell-side analysts or uncovered by sell-side analysts, which gives us, as active managers, a really nice opportunity to find very high quality businesses that are under institutional radar that will allow us to outperform over a long period of time. Secondly, I think we also are very aware that small caps tend to outperform large caps over time. And so from our experience, the space not only offers active managers a fantastic opportunity to outperform the index over time, but also allows many investors to participate in what is a higher return space over a long period of time, and allows for better portfolio diversification as well. Here is a brief slide just quickly talking about where excess returns are generated in the market. The Fama-French model is a fairly famous model in the academic space. And returns have been proven to be generated really in three places. One is traditional beta, so that's just exposure to the market. The second is access to small cap stocks. And the third is having a value mindset. And all three of those things are really what we've incorporated into the Lizard process and into the Pengana Global Small Companies Fund that we think will allow for investors to achieve excellent returns over a long period of time. Moving on to slide 10, I think this slide really just sums up what we're discussing visually and really shows you the difference in the outperformance of global small caps versus global large caps over a long period of time. Here you can see global small caps have generated almost 7% a year return over the last 20 years, while global large caps only about 3.5%. So fairly significant outperformance in the small cap space. The other point I would highlight here is that has not been true over the last 2 to 3 years, with large caps actually outperforming small caps. And we think, that sets up well for small caps outperforming in the next 3 to 5 years. So slide 11, I think, is just a visual representation of when small caps tend to outperform versus when they underperform. And here, you can see small caps have underperformed for the last several years. And again, we think reversion to the mean will kick in, and small caps will tend to begin outperforming at some point, and outperform in a pretty significant way, as you see, which occurs coming out of most crises. Here, and I think the next piece is back. I made the point about active management and why active management in the small cap space can really generate significant alpha over time. And slide 12 is really, I think, a key point here. Here you can see, in the large cap space, almost all companies have coverage. Same in the mid cap space. You have significant analyst coverage both in the large and mid cap space. However, in the small cap space, you have significantly quite a few companies totally uncovered. Much fewer analysts are covering each name, and you have a situation where there's just an opportunity for research to provide you a real edge in this space, because there just isn't quality research being done in these names. So we view that as our edge, and really our discipline is to provide very deep levels of research and really gain an edge in understanding the businesses we invest in, which we think is very hard to do in the large cap space, but is certainly possible in the small cap space. So now that we've talked a little bit about why we think there's an excellent opportunity in the global small cap space, I'll talk a little bit about how we've honed our investment philosophy and what it is we try to achieve in our portfolio over time, and why. So the investment philosophy is really honed around buying very high quality businesses that will deliver excellent returns and offer the best long-term preservation of capital. We think both of those things are true. So we think buying high-quality businesses with good balance sheets that will generate high returns and have an ability to recycle capital into their businesses and grow will not only deliver the best form of compounding for our investors, but also these are the businesses in crises that tend to outperform pretty dramatically, take significant market share, bolster their competitive position, and frankly preserve capital better than the highly leveraged, more cyclical, lower quality businesses that we tend to avoid. So we really view our process as making sure we're finding the best businesses under the radar out there and letting them compound for our investor base. And I think how we find these businesses and how we source them and how we do research on them is really where the magic happens. We have been working in this space for over 10 years. We typically have between 300 to 400 interactions with management teams a year, whether it be in-person meetings or calls. Obviously, they've shifted more towards calls in the more recent environment, but we've met with thousands and thousands of management teams over the last 12 years. And so we have really built a very good working knowledge of our market cap, of the companies in our market cap spectrum. And we really have honed in on those business models that we are interested in investing in and focus on those. And that's what we think allows us to really source and diligence the right types of businesses for our product. The other thing we think is important in our space here is the ability to concentrate into our best ideas. And that is why we stay small. We think small is beautiful. The top 10 positions in our fund typically represent between 30 and 40% of our portfolio. We believe limiting the amount of capacity in our fund allows us to concentrate in these small cap ideas and really generate returns. And so for us, again, small is beautiful. We want to concentrate in our best ideas because we really think that's where a lot of the alpha generation really happens. And our valuation discipline, we talk about being value investors. We really think about things on a cash flow basis. So we invest in high quality businesses. We look at cash flow based valuation metrics, and we want to be paying about half of what we think a business is worth on a 3 to 5 year basis using conservative assumptions. And that has been very successful for us over time. So what does a portfolio actually look like, and how do we construct it? What you would typically expect is the portfolio will be 80 to 100% invested, typically about 95% invested over a cycle. Currently, the portfolio is at about 93% invested. Concentration, again, I think our fund mandate says 30 to 80 positions. However, typically we're about 30 to 50 positions. Again, I referenced that top 10 being about 35 to 40% of the portfolio. And the average position size for us is about 2 to 5% of the book. Another thing that I think separates us from a lot of other investors is that we have a longer term investment horizon. Average annual turnover is about 40% over time, and our investment horizon matches that, which is about 2 to 5 years. So again, we want to buy these businesses and allow the really good ones to compound for us for a long period of time. Within the book, you're also going to get a diversified view of sectors and geographies. So we don't want to have any large thematic bets throughout the portfolio. So you'll get a fairly diverse set of sectors, geographies, with the exclusion of limiting some sector exposures. So generally, given that high quality business model that we try to find, we tend to be light on energy, materials, and other types of businesses that tend to earn lower returns over a long period of time. And I think slide 16 is an interesting one and highlights a little bit of what I was talking about. The first on the regional in the upper left, here you can see we tend to be, we are underweight North America, and I think that's a fairly consistent underweight for us. And we're frankly overweight Western Europe. That is an active decision. I think we find the opportunity set certainly skewed towards ex-North America, given valuations and where they exist today. And that has not been a huge driver of performance in the last couple of years, but we believe, that we see some signs of that tending to reverse. From a market cap perspective, I think what is unique about our fund, and here you can see where our market cap on the upper right chart, where our assets are relative to the index, and you can see we skew much smaller cap than the underlying index. We have, in terms of names over 10 billion, we have a very small weighting, and then names under $1 billion, is our second largest weighting, well over the index. So again, we really believe in finding those under the institutional radar names that we think can drive value in the portfolio, and you see that represented by our small cap bias in the book. And then back to the sector exposure of what I was discussing before, you can see we really have no exposure to energy or materials, but do have quite a diverse exposure across the different sectors. And again, this is really driven by the types of business models in those sectors and finding those business models that meet our high quality threshold. Moving on to our recent performance, I'll touch a little bit on our performance and then specifically talk about what we're seeing in the current environment, which we think, is a bit unique in our experience. And I think a lot of investors are rightly focused on, what is next now that we've been through quite a tumultuous period. So on slide 18, here is the fund's performance over the compared to the index over the last since inception in March 2015. Again, please remember we've been running our portfolio here in the U.S. since January 2009. You can see we've outperformed the index by a little bit over that time period. More recently, performance has been quite strong. And I think, what as you would dig into our performance over time, what you've really seen is stock picking across different geographies and market cap sizes has been quite good. However, what has prevented us from outperforming more dramatically has really been the underweight US and the fact that large caps have outperformed small caps. Those two things have really held back our performance on a relative basis, but our stock picking has been quite good across that time period, and I think that's really what we focus on. Moving on to slide 19, here's a representative peer set performance against our performance. You can see we've pretty consistently outperformed our peers over time, and I think more recently in the downturn, given our value bias, have outperformed by a pretty wide margin. And I think this is representative of what we would expect over a long-term time horizon to be able to outperform the other offerings in the market. So how is it that we handled the crisis and what, call it the crisis in March and the subsequent move up in stocks in the last few months? When we entered the crisis, I think, David and I spend a lot of time about always being prepared for a crisis, because once you're in the crisis, you need to be able to move quickly and act decisively. So as we entered the crisis, we really set two goals. One is to preserve capital in the short term. We had never seen a crisis like this before. There were many sectors that were going through very serious demand destruction in a time period that we've never seen, whether it was aerospace, restaurants, retail, a lot of different industries. So we were very focused on short-term capital preservation. And we also wanted to use the crisis to acquire superior businesses that would really drive our portfolio for the next 3 to 5 years. And I think we've done a adequate, good job at doing that over the last 3 to 4 months. And I think you can start to see some of those businesses we acquired in that March and April time period really start to drive the portfolio. How did we execute on it? Given that we have 10 years of experience in the space, we dramatically and have built contacts and networks with management teams around the world, we dramatically increased our interactions with management teams. Typically, you would see us have 30 to 40 interactions in a month. We had 178 interactions with management teams in a 5-week period to really get on the ground and understand what was going on in different industries. That is really what allowed us to act quickly and decisively and move capital in our portfolio into those names we really wanted exposure to. So you did see an increase in trading activity as we repositioned the book to really drive the book for the next 3 to 5 years, as I said before. So where are we now, and how are we approaching the world now? We still think the economic impacts of COVID are going to be felt for a while. The outcomes and scenarios we are looking at are still quite broad, and I think it's challenging to predict exactly how the world will look in 3, 6 months, or even a year or 2 years. The government, the other large question out there is, will the government intervention be enough to offset more persistent issues associated with COVID, especially as we see cases start to tick up again around the world, specifically in the US? And then thirdly, I think, how long will interest rates stay low? And we believe it will be for a very extended period of time. And what will the implications be for valuation of equities, as well as driving the economy? I think the fourth thing we're thinking about is really, I talked about this briefly, but demand destruction in a lot of industries may be more persistent than we expect. And if that's the case, those industries will have to undergo fairly significant restructuring, taking capacity out, whether it's airlines, hotels, and those restructurings are typically bloody and painful. So we want to make sure we're staying away from places where we think there's going to be a lot of overcapacity. And I think lastly, despite the surge in stock prices, we're still finding very good opportunities. We have a very full pipeline. David and I continue to be pretty excited about the future, and especially what we're seeing in the small cap space. There's plenty of names to look at, and I think that we feel more positive than we have in a while about the opportunity set in front of us. So while if you look at the market bottom in March, the risk reward is a little more balanced, we still think the opportunity set is quite good in what we're looking at in our pipeline. Now I'll just chat about a couple case studies that will hopefully bring our process a little bit to life in terms of what kind of ideas we're looking for and how we source them, how we actually buy them, how we find them. The first company I'll chat about is a business in the UK called AVAST. AVAST is a market leader in the virus protection market for consumers. They operate a freemium model, meaning that their base offering you would download for free. You would operate kind of free virus protection. And then they offer value-added products, enhanced virus protection, VPN, other types of services like that for money, and that's how they generate their revenue. And so it's a business that has gone from no users to over 400 million users over the last 20 years, is one of the global leaders in the virus protection space. And the management team has been consistent throughout, and they've done a great job monetizing this business over time. It's a business we've admired since they IPO'd a few years ago, and we spent a lot of time with the business over that time to really learn the business. We had initially entered the position in December 2019. and quickly exited around some negative news flow that was generated on one of their business units. This news flow hit, and then the crisis hit, and you can see the stock was just eviscerated in the January to March period. We used that as an opportunity to really acquire shares of a business that we thought that we think is an excellent cash flow generating compounding machine. We think this business will continue to grow. They actually will benefit from the crisis as you have more people working from home, more need for VPN, all of those types of things actually drive their business. But this business in the crisis was selling at a fairly serious discount, given to some misunderstanding about what this negative news flow was. This is fairly typical in our space where you will have violent stock reactions, and some of it warranted, some of it unwarranted. And in our view, this was fairly unwarranted. We were able to acquire the stock at very attractive prices in the March time period. Stock is currently trading 30% above our cost base in the business, and it's currently about 2.7% of our portfolio. But a name we think will continue to compound for a long period of time. It's got great management alignment, very good returns on capital, and all the things we look for in a stock. Another name we have been acquired earlier in the year is Kindred. Kindred is a sports gaming business, so a gambling business, if you will, that operates in Europe and is beginning to operate in North America. They operate two divisions effectively. One is casino operations online, and the other is sports gaming online. So it's a pure online gaming business. This company represents about 3.4% of our book currently, and it's it's currently trading at 25% above our average cost base. We've known this business since 2010 when it was actually called Unibet. We have always been very impressed by management team, and I think one of the things that really, if you go back to a longer term chart, this company has had a tough ride the last couple of years, and one of the things that really drew our attention to the name was a CEO stepping in and buying significant stock starting in about late 2019. What we like about this business, the business, again, you had a massive stock price reaction to some regulatory changes in Sweden, which had a 1-year impact on earnings. Again, we think that is more of a temporary issue on the earnings front, and you'll see earnings start to normalize this year. This market is structurally growing. The online gaming space, given that it's regulated, given that there are constantly more concentrated suppliers, earns very high returns, very consistent growth over time. And we've been buying this business at a high single-digit earnings multiple, which we find to be very attractive for a high return, high growth business. We also like that you have a bit of a free call option in this business. As US gaming starts to open up, European players have been operating in this space for the last 20 years. They have the technology and the know-how to offer in-game betting, which we think is really important. And so we think you have some free optionality in this space. We also have another investment in this space called Kambi, which will be a more direct beneficiary of the US opportunity I was just speaking about. The last business I just wanted to touch on is Swedish Match. Swedish Match is a Swedish tobacco business operating mostly in the snus space, which is effectively clean chewing tobacco. What we really liked about Swedish Match at a high level is it is a high return on capital business, growing reasonably rapidly, and we were buying it at a mid-teens cash earnings multiple. However, embedded in the business was a product called ZYN. ZYN is a tobacco-less chewing tobacco, if you will. So think about like a nicotine. ZYN would be comparable to nicotine gum. This product is exploding in the U.S. given the health benefits, which is a very healthy version of nicotine, is exploding in the U.S. The business grew over 300% in the first quarter, and we think provides tremendous optionality. So not only do you get a fairly attractively priced tobacco business with high returns and reasonable growth, you also have the optionality associated with a product that is currently exploding in the US and still penetrating the market in a pretty dramatic fashion. Just touching quickly on our winners and our losers over the last 6 months. what you'll find is pretty consistent with the underlying market. A few of our technology names have performed very well. Enghouse, Fiverr, Medley. Our discount retailer, Dino Polska, which is a food discount retailer in Poland, also performed quite well, along with Swedish Match. Some of the names that haven't performed as well, I think, are back in that demand destruction space. So we had an energy name, Nesser, National Energy Company, that struggled. Autoleave in the auto space, and Pico in the Pico operates in the conference space, all struggled. We have exited 2 of those positions. We continue to own Kruk and Served and are currently exiting Pico. But again, back to this concept of trying to limit downside, we try to move out of these names fairly quickly as the crisis struck. So that is really what we've been up to, what we've been operating now. I'd like, I think we are very excited about our space and the opportunity set ahead of us, and how we've repositioned the portfolio, and we think we're well positioned to perform for quite an extended period of time here, given that our space has been out of favor. I'll now turn it over to my partner, David Lee, who can answer any questions for you.